Welcome to the MTA Podcast Series, a weekly audio cast featuring interviews with recognized industry professionals. And your host, Ed Carlson.
Monday, February 8th, 2010. From a longer-term perspective, I continue to believe that equities are correcting with the benefit of a solid technical backdrop. We're buyers on weakness and believe the underlying trend is still the market's friend at this stage. Today's guest from Strategas Partners is Chris Verrone. Prior to joining Strategas, Mr. Verrone worked with the economics team at International Strategy and Investment, ISI Group, and at the Foreign Policy Research Institute. Mr. Verrone earned both his Bachelor of Arts and Master of Arts degrees in Comparative Politics and International Political Economy at Villanova University. Chris Verrone, welcome to the program.
Thanks, Ed, and thanks for having me as a regular listener of the podcast. It's finally nice to be invited.
Oh, well, wonderful. Glad to hear that. Listen, Chris, today we're going to mix up our format a little bit, and rather than starting with Chris Verrone in diapers, we're going to start by asking about the firm Strategas Partners. Maybe you can give us a little background on the company before we get too in-depth into Chris Verrone.
Great, Ed. The firm Strategas was really born out of ISI Group. Our managing partner and chief investment strategist here at Strategas, Jason Trenner, and his two partners, Nick Bonesack and Dan Clifton, started Strategas in September of 2006. Jason was formerly the chief investment strategist at ISI for about 10 years, and it was over at ISI where I got to meet the group, and they started the firm in 2006. I came over in early 2007, and really the focus of our firm is to provide top-down macro equity research from a more non-consensus point of view. We really focus on four key products here at Strategas. That's our investment strategy products. That's our top-down macro equity research. Our economics product, that's our macro-driven, more quantitative approach to forecasting the economy. And we have a policy research product headed up by Dan Clifton, who's out of Washington, D.C., whose goal is to really identify, say, legislative drivers and changes on the policy front that impact share prices. And then lastly here at the firm, I run our technical product, where we take very similar to the firm's approach, a non-consensus view to approaching security prices. We look for opportunities that might be out of favor among the street, and we pride ourselves on providing a more differentiated view to our institutional customers.
Mm-hmm. Well, who is or what is the typical consumer of your research?
Great. So our client base is entirely institutional based, so it's basically across the spectrum and relatively well represented among hedge funds, mutual funds, long only guys, pension funds. So basically the entire institutional spectrum we have a presence with, which I think is important because a lot of the good ideas we get for our work often come out of questions from our clients, and since we have such a diverse group across the institutional space, the refrain you might be hearing from a long-only manager in Wisconsin is very different from the refrain you might be hearing from a hedge fund manager in New York City. So, I feel our diverse client base really allows us to hit on topics that the street might be missing.
Well, I'm glad you mentioned a diverse client base because that opens up a question that I was dying to ask, and I think a lot of our listeners would be interested to hear as well, and that is, what kind of reception or acceptance of technical analysis do you see from such a diverse client base? So is everyone eager to hear you and your team's research, or do they just put up with it? I'm sure there are those that eat it up with a spoon, but give us kind of what feel.
Well, I hope they just don't put up with it, but I'd say the acceptance of technical research has changed dramatically over the last 24 months. It was, I think, a difficult environment for technicians from, say, 1982 to 1998. when essentially it was passive investors who basically, if you bought the index, interest rates were going from 15 to 3, inflation was going from double digits to 2, and essentially if you were a passive investor, you did quite well. And I think that's really changed, particularly over the last decade, as we've seen a lot more volatility in the markets. It's really turned into more of a stock picker's market. So to the extent that we're able to identify, actionable ideas across a variety of asset classes, to the extent that we're able with the equity markets to provide our outlook on what the market is going to do this week, this month, this year, and put that into a type of presentation that is concise, that is clear. I'd say that the reception of technical analysis, even more so over the last 2 years, has really been quite overwhelming. And again, I think it speaks to the volatility we've seen in the markets over the last couple of years. And if you consider, I'd say, a lot of the forecasts for what to expect over the next several years, this idea of, say, a range-bound market that is very similar to what we saw in the mid to late 70s, I think that's another environment that is ripe for the technician to do quite well. I'll give you one example. A mentor of mine, Ralph Alcampora, who got me into the business and who got me to be a follower of technical analysis, was one of the first things he told me is that one of the scariest markets he ever was a part of was that late 60s market where it just kept going up. So when I talk to a lot of our clients, I'd say, the fear isn't necessarily that we're going to, say, retest the March 2009 lows or go into any prolonged bear market again. I think the fear among our clients is that we enter a market environment much like the late 60s where the path of least resistance continues to be higher, and I think it's there where the technical analysis can provide a lot of insight and a lot of value add in identifying, say, overbought and oversold conditions in a near-term outlook, and also providing a very actionable longer-term forecast.
You mentioned presentation. Just as an aside, you for our listeners' benefit, you'd sent me several research reports, and one thing that really stood out was the charts. I really like the charts you use. What software are you using? Is this something you guys made up yourselves, or is this a package turnkey product?
The presentation approach really across all our products is basically less is more. We like big charts. We like as less text as possible. We think if you can't convey your message in the title alone, you better work on refining that message. So our approach is really to limit charts to basically 1 or 2 a page and have very limited text, and we feel it's an effective way to get our message across to an institutional community who has already way too much to read. So that's really our approach with presentation. And I think anytime you can show a client one chart with one title or one comment and get your message across, I think that's a real value add. I remember a strategist I know well, a very successful strategist, once told us that if you were doing a 40-minute presentation, see if you can do that entire presentation with just one chart. And that's really the approach we like to use when we put out our published research.
Well, you mentioned we, and I was going to ask you, when I look at your research reports, your name is not the only name on those reports. You've got quite a team working for you. Can you tell us a little bit about the team responsibilities and how you all work together?
Yeah, I'd say one of the unique aspects about our firm is that our message and our investment thesis is always cohesive across our product verticals. So our macroeconomic forecast is in line with our top-down fundamental forecast, and it's being informed by our technical outlook, and it's being informed by what we see going on in the political spectrum down in D.C. So we're very conscious in keeping our message and our investment thesis uniform across our products. I think the problem a lot of people can run into at bigger shops is the message almost gets lost in the amount of product that's offered. So from a publishing perspective, we all work very cohesively in keeping true to that goal.
Well, so are the other names on these reports, are they not technical analysts?
Yeah, so at the shop, at our shop, I'm the only one covering the technical side of the field, but every other analyst here is either an economist or either an equity strategist from a more fundamental perspective. So the way we approach the technicals and the fundamentals is that we think they simply complement each other. We like to identify compelling fundamental stories, and then we like to see what the technicals are saying. I would say this very cohesive approach, I think, is a key reason why we don't get into a situation where our economics team might be saying one thing, but our technical work might be saying something else.
Mm-hmm. Well, you've led right into the next line on my notes here, which was tell us how you incorporate fundamentals with technicals, and maybe you've already answered a big part of that. But where does the rubber meet the road? Do you have like a morning meeting, a conference call? How do you literally go about incorporating the fundamentals with the technicals?
Sure, that's a great question, Ed. Essentially, I guess not surprisingly, basically every day, all the analysts here, the five of us, gather for strategy sessions where we basically lay out our views across our respective product verticals, and we try to determine where we're in consensus, where we're out of consensus, where there's opportunities we might be missing. And I think a big part of this is the feedback we get from our institutional clients. Like I mentioned earlier, you wouldn't be surprised, but a good number of the published research that we write is the direct response to a number of client questions that we'll receive throughout the day. And we discuss all of that in these daily strategy sessions where we basically refine our investment thesis and we stay concentrated on making sure that it's very cohesive across our product verticals.
Mm-hmm. I see. We're going to continue with Chris Verrone in a moment, but first a reminder that on next week's program we'll have from Bloomberg Television in Hong Kong, Bernie Lowe. Chris, once again, your answer to a previous question leads right into the next line of my notes. If you haven't already finished, let's go ahead and finish with telling us what your typical day looks like.
Sure. So my typical day here on the technical team at Strategas is every morning we have a internal firm call at about 7:30 a.m. where the analysts who are publishing that morning will present their work. Each analyst here publishes about 2 or 3 times a week. So on any given day, I may or not be publishing from the technical side. So we'll go over that work in the firm-wide meeting at 7:30. And then really from there, it's essentially off to the races doing one of 2 things. Number one, if we do have a piece out on the technical side, it's getting in front of our client base, it's answering questions that the piece presents. Often we'll put out a piece and in our inbox not long thereafter, there'll be several questions from clients asking, can we see this done a different way? Can you do this analysis, a more custom approach? And kind of our approach here at Strategas is that really our written work is only, say, 50% of what we do here. The other 50% is doing a lot of custom work for our clients, and I think that is especially true for the technical product where we obviously cannot cover every security a client might have in their portfolio in our written work. So it's the custom work that allows us to get in front of clients, especially on the equity side, and help them identify turns in their portfolio or help them identify turns in in a stock, whether it's overbought or oversold, or just some more general work that they might be missing, especially when a lot of our clients are bottom-up investors and they're so in the weeds in their in their universe of companies that it's almost easy to forget what the more macro technical indicators are telling you. So that's really how we think from the technical side that we can be a value add. So that really makes up the majority of the day, and I'd say really the other aspect here is preparing for what is going to be written next, what will be published next. So given that we really publish 2 or 3 times a week, that's not an everyday task, but it's something that nonetheless it does take considerable time when you are the publishing analyst who is scheduled to write the next day.
I see we're down to our last 5 minutes. Once again, these interviews go so quickly because
they go so fast.
Yeah, it's fascinating to hear another analyst speak and talk about their what they're doing. But we've got to get into your views on the market, particularly given that I know you're bullish. I'm going to repeat that quote that you had written from the beginning of our interview today. From a longer-term perspective, I continue to believe that equities are correcting with the benefit of a solid technical backdrop. What is a solid technical backdrop?
Well, let me make a couple points here. There's no question that the market is in some consolidation phase right now, and I think a lot of the questions investors are asking themselves is this going to be a repeat of what we saw in the correction phases in June, July, and early October, or is this going to be something more serious? And I'd point out a couple points that, in our view, would suggest that this is likely a buying opportunity from here. And let me make a couple points here. I'd say, number one, I think it's important to remember that the market, when I speak of the market, say the S&P 500, the 200-day average is still in an upward sloping trend. So trend at this point is still in the market's favor. Trend is still transitioning higher. I'd say, number two, if we look at the equity market as a whole, the pattern of higher highs and higher lows has not been broken yet. Since March, in each of these consolidation phases, the low has been higher than the previous low. That's an important distinction to make. I'd say third is, despite some of the equity volatility we've seen over the last several weeks, I think it's important to recognize that investment-grade credit spreads still remain near 2-year lows. So we're not getting a signal from the debt and credit markets that would suggest that this right now can manifest into a more serious sell-off. And the last really thing I would highlight here is a proprietary index that is unique to us. It's our proprietary bellwether index. It's a collection of the 15 S&P 500 stocks with the highest correlation to nominal GDP growth. And so we really created this index to be a very cyclical representation of the market. And the fact that that index is not breaking down yet is another piece of evidence that would suggest that this market is probably more resilient than people are giving it credit for right now. So I think when we take those 4 factors in whole, in their entirety, I still think we're in a period right now where it probably makes sense to add to your long exposures. If we're thinking about downside risk, I could see us correcting to, say, 1035. That would be about a 10% move off the January highs. Maybe worst case down to the 200-day average at about 1020. That's kind of my general market framework right now. And then if I could just add one more point, I'd say one of the most important indicators I think we can be watching right now as technical analysts and market observers is what the semiconductors are doing. And I say that because if we look at the relative performance of the semiconductors really over the last 18 months, they started to outperform the broader market in December of 2008, so a good 2 or 3 months before the broader market bottomed in March of 2009. A similar roadmap began to play out in June and July of 2009 as the broader market was still correcting. So semiconductors started to outperform again before the broader market bottomed. And we saw the same pattern develop in the late October, November correction phase, where semiconductors started to showcase leadership. And when I think about what we saw last week, well, the market was down about 1%. Semiconductors were up about 1.5% last week, and we're seeing continued strength from the semis this morning, up about 1.5% as well. So I think in terms of what's the most important signal we can be watching to see if this market is turning, I would keep my eyes on the semis. And I'd say from here, renewed leadership from the group would be a very good signal that the broader market consolidation phase is coming to an end, and it might be a good time to get back involved on the long side end.
Mm-hmm, mm-hmm. We are pretty much out of time, but I think we can't let you go without finding out how did you make the transition from your studies at Villanova of politics into technical analysis? You mentioned Ralph Akampora's name. Maybe you can give us a quick 30 seconds on how Chris Verrone got into technical analysis.
Great question. So I'll start by saying I entered the business on the fundamental side, doing more investment strategy, more macroeconomic work. And then it was actually a meeting with Ralph Alcampora, who I met some time ago, who really got me interested in the technical stuff. He gave me a quick story about his experience as a young analyst on the street, and in the late 60s, early 70s, where really technical analysis was beginning to really gain a lot of prominence, especially as the volatility of the 70s took over. And I looked at the volatility that we've seen really over the last decade, and I thought, wow, this seems to be like an undercovered area across the street. It's something I have a lot of interest in and something I think I could be pretty good at. So I really credit Ralph Acampora with getting me involved on the technical analysis side of things, and to this day, he's a very important mentor of mine. He's basically taught me a lot that I know.
Oh, that's great. That's real nice to hear, actually. Well, that wraps up today's MTA podcast from Seattle. I'm Ed Carlson. You can follow me at seattletechnicaladvisors.com or contact me at ed@seattletechnicaladvisors.com. Send us your comments and suggestions. Let's keep our stops tight. Good day.